Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Aaron back in the studios with us. Hey, Aaron.
Hey, John.
Well, end of the year isn't that far away. And it's time to, quote unquote, take stock.
Are you talking about 2020?
No.
Year end?
I'm talking 2019. It's time to take stock.
All right, take stock and maybe a look back.
Okay.
All right, let's talk about the last year and the last quarter. I actually talked about this a couple of weeks ago, and in my material, I didn't get through everything. So I want to go back, recap, and then we'll get through everything today. I promise.
Okay.
Okay, you give me that, that warning of how close we are, and I'll follow that warning.
We always edit out the siren that goes, people don't know.
Yeah, it is scary. So let's talk about, last year we were all, those of us that were invested in the market, we're all mostly happy about that. We had a good year. The S&P 500 was up near around 30%. There's a lot of indexes out there that track the S&P 500 that you can buy. And I've seen some that were, 30 to 33%. I've seen some, 27 to 30%. I got any caution on the lower side, 27, 28%. But it would have great caution, right, to have that kind of return. But remember, in 2018, the S&P 500 was down near 5%, 4.5% to 5%. So it makes sense that we have a good, solid year. I tell this story, too, to clients. The markets don't see calendars, right? There's no, it's a human being thing. We are the ones that create a January 1st to December 31st calendar. So where markets fall, on that day, whatever the number is for that year, that's your, up or down number for the year. That is our number. That's not a market number. So in 2018, the market declined from December 15th to the Christmas Eve. It declined about 12 to 15%. That's the S&P 500. Significant. If it's one of those things. If it was a week after that, we'd all be remembering that. And I did some chatting about that on one of these shows back then. So that decline put us in the red about a negative 12% on Christmas Eve. From the day after Christmas, so December 26th, 27th, 28th, 29th, 30th, and 31st, the market recaptured all that but that 4.5% to 5%. So you could see if the calendar year would have ended on December 24th, we would have had a negative 12 to 15% year. So looking at 2019, it makes sense that we would have such a run-up in the market. There's some other factors, of course, that might have gone into causing that, but mainly we just had good, positive information, good quality domestic economic information. So about that, too, domestically, when you have good relations with other countries, which it was a little hairy there with China for a while, and it seems like it's getting done, this whole tariff fight back and forth. And then at least we had a signing of a tariff or trade pact that they call it phase one. But what I see is from all the gurus out there that talk about it, this is significant and one of the most important part of the trade bill. The other big part is the technology part that they haven't really figured that out and came to a conclusion. But a lot of people thought or think that we signed this bill, the president signed it to, or I should say agreement, signed this agreement with China, and then all the tariffs went away. That's not the case. Many of the tariffs stayed in place, exactly what they are. So that's still going on both sides. But what happened is some of the things that China just said they weren't going to buy, or the tariffs were so high, and vice versa, they have been eliminated. So that has freed up a lot of stopped product that was just sitting and waiting to be distributed or to be purchased by either country. So that was signed, and hopefully we can get it done through in the summer. They said they want to get done the second part or phase 2 of that. And who knows? There might be a phase 3, phase 4, phase 5, but that's politics.
Keep piling stuff up on the docks there before.
That's right. I mentioned this last time we talked. The Federal Reserve made 3 interest rate cuts last year. That's always a positive sign, typically for the economic future. Well, the stock market, is a predictor of the future. That's what it does all the time, every day. I call it the big boys and girls out there that are making those huge trades in the market. They're shifting the markets up or down on a daily basis or a weekly basis or a monthly basis or even over a quarter or a year. Those folks see an interest rate cut as a positive thing, especially when you don't see a huge economic decline or a looming recession. The Federal Reserve thinks it's appropriate that they're going to just take steps to keep the economy, at this slow burn, if you want to call it, and it's been doing pretty good. We had a good gross domestic product number come out. It's going to be somewhere around 2%. Third quarter of last year, it was 2.1. In a couple other quarters, it was down a little bit. So that's why we saw some market, pull back in the second quarter, or at least kind of had a little lull there for a while. But I see things, heating up or picking up a little bit more this year, and that's surprising to the economists that were kind of the naysayers early in the year of 19, and they're the ones that kind of picked things up in the middle of the year, decided it was going to probably get better.
For me, I don't understand some of the stuff. We don't seem to get any kind of upward pressure, not on wages, not inflation.
Mm-hmm.
The only upward pressure we get is the market valuation.
Right.
So I don't know how long we can sustain this, but
I agree.
I've never seen anything like it in my whole life.
No, and we're looking at me. Just look at me starting in the business in the year 2000. 2 significant downturns in the market from 2000 to 2010. 2 significant downturns. I mean, the Great Recession in 2008, gave back, the S&P 500 at one point was down over 60% in that year, going into 2009, and going back to 2001, 2, and 3, the markets are down 60% around there, and we haven't seen that since 2010, and here we are in 2020. We've had a couple of declines, 2015 and then 2018, and you could go back to 2011, 12, and 13. In there, we had you want to call it a mini recession. We just had a lull in the economy. So I am always cautious, but I was, talking this way, 2015, 2016, 2017, 18, 19. We got to have a downturn at some point. So let's invest, cautiously, but appropriately, to make sure that if the market does give good returns, we capture as much as we can. So there's nothing wrong with being protective, but you always need to be in the market. If you can handle that, the ups and downs of what the market, the volatility part of the stock market, in some fashion, you need to be in that market. But if you can't handle it, it's keeping up at night, and it's part of your daily stress. Maybe the political climate is causing you stress, today or this last few years. If that same stress boils over to your retirement plans and your accounts, then maybe you need to look to, be more conservative. So I say continuously, just invest appropriately and have that plan with your advisor or yourself that says, I can invest in a way that will allow a market decline of maybe 12 months, maybe 18 months, maybe 24 months. I want to make sure that I can afford that loss through that period of time, because I know over long periods of time, you get rewarded. If you stay invested, the market will reward you. So you had to bring that up, just get me going.
I'm just saying, I just never seen anything like it. So
no, and it puts a smile on our face, that's for sure. So I talked about domestic. Let's talk about the world. We had positive gains across the world, but the rest of the world is still, for the most part, struggling. And when I say the rest of the world, I mean almost every country. There's been so much investment, and it maintains this. It seems like decade after decade, so much investment in this country. And of course, I got my own opinion why that is, why people keep coming here, right? The immigrant, population is, 1 million plus a year. That's what we let in legally, right? That comes here. There's no other country that either allows that or has that many people that come in. And we're not the largest country out there. I mean, we have a, 330 million population, but we're not one of the biggest countries out there. They do not let in immigrants, or the immigrants aren't going there. Why are they coming here? Because of opportunity. So I think when we see world markets struggle, that's one of the reasons. We're always going to be a forefront because of our policy, continues to allow immigrants in this country. No matter what you might think what the media says, just do a quick Google search. It'll tell you all the information you want to know of how many immigrants come in this country. Good quality people, right, want to come here, the ones that want to work, the ones that want to take some of those jobs that we need people to fill. That's my soapbox minute. Real estate. So real estate mortgage rates have maintained a good number, a good low number, I would say. 15-year conventional is somewhere around 3.1%, and the 30-year mortgage is about 3.7. That's about the same as it was last year at this time, and we're seeing, continued. No pressure up or down in those mortgage rates. When the Feds lower rates, it's a complicated reason why rates get cheaper in that world, and I won't even try to explain that. Maybe one day I will. It's interesting. I've kind of been buffing up my education on that side of the business, but you got to make sure that you are, if your rates are somewhere, 4.5%, 5%, 6%, and you have the ability to refinance, you should look at that. And it's interesting. I have people come in sometimes, and I'll do my data gathering meeting and ask them, mortgage, what's your rate? And they'll say, 4.9. And they've had that rate for a long time, for 15, 20, 30 years. And I'll say, let's take a look at this and see if it's in your best interest to refi. All right, here's a tip. I call it the tip of the quarter. So last quarter, or the beginning, right, of 2020, the tip of this quarter. And a lot of people have seen this. I know it's out on there on social media, and the news media has talked about this. But if there's somebody out there who hasn't heard this yet, you may want to abbreviate. You may not want to abbreviate the year 2020 on financial, insurance, legal, and healthcare documents that you sign and date. If you write 2/1/20, so February 1st of 20, and there's enough space left after that 20, somebody who's unscrupulous could add a couple numerals after that and change the date to 2/1/18 or 2/1/17 or so on. So this is one of those years. I don't think we're going to have one another in our lifetime. You want to put in there 2020 when you sign documents. It makes sense.
Absolutely. Absolutely.
Yeah. If anybody has any questions, they can give me a call, 265-3540.
Thanks a lot, Aaron.
All right. Thanks, John.
That's Money Talk with Aaron Ricketts, presented by Ricketts Associates, 3245 North Adrian Highway, Suite L. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.